Yeah, I think numbers and ratios matter. So I think that on a per coin basis, individually held coins are a lot more impactful in terms of hard fork outcomes. But of course, there's a different world where 20% of coins are held by big entities versus 80% of coins held by big entities. And as it stands now, the majority of coins are out in the wild. A lot of whales and smaller investors. And even the big ETF inflows. I mean, you had over 600,000 coins in GBTC, and a lot of those diffused out and then into the other ETFs. And of course, there were net inflows. And they're up to something like 1 million plus coins now. But that's a 400,000 coin gain, which is not nothing. But it's not as though they're gobbling up vast amounts of the network. So I think that's where ratios do matter at the end of the day.
As Bitcoin's price surges to unprecedented levels, the unseen market forces shaping its rise have become more crucial than ever. In a market fueled by speculation, power struggles, and shifting dynamics, the distribution of Bitcoin ownership is one of the most important factors to watch. In this interview, Lyn Alden highlights the tension between individual holders and centralized giants, like ETFs and whales, whose influence could either stabilize or destabilize the market. While ETFs such as GBTC have amassed millions of Bitcoin, their power is diluted by the widespread ownership among smaller investors. This decentralized distribution safeguards Bitcoin's core principles. Alden points out that individual holders, not institutional players, hold the real power, especially during key moments like hard forks. As Bitcoin's price climbs, the balance between decentralized control and concentrated wealth will determine the future direction of the cryptocurrency market. Watch clips from Lyn Alden's interview to gain more insight. Don't forget to like, subscribe, and enable notifications for additional in-depth content. Enjoy the video.
So in the paper, we broke it the stakeholders up into 6 different types of groups. So it's probably best to start that high level. And that's because there's no one type of entity that has all the power in Bitcoin. It's delegated out. And there's different actors with different powers and different incentives that are operating as part of this consensus mechanism. And so the 6 groups are, the first one is economic nodes, like you mentioned. The next one is investors, so people that hold significant amounts of it, or many people that hold smaller amounts of it. Then there's miners. Then there's influencers, anyone with a significant audience within the space. And then there's 2 types of developers. There's protocol developers, and then there's application developers. And for economic nodes, we made that distinction because, even though you could be running the same node software as someone else, some nodes are more impactful for the network than others by orders of magnitude. And it's largely related to how much volume that they're doing, and how much, impact they're having on what people define as Bitcoin. When they exchange one coin for Bitcoin or fiat for Bitcoin, those economic nodes, whether it's exchanges, brokers, payment processors, they're playing a pretty significant role. So, for example, what software, Coinbase or Binance are running matters more than what my node is running, especially if I'm not doing very many transactions. If it's just kind of running in the background, not doing much, those 2 nodes have different levels of impact on the network. So for that one stakeholder group, economic nodes, we kind of go into their different types of powers. And when we broke these like 6 groups up to kind of identify what are the groups even are, we could have landed on different numbers. Like we could have found that there were 5 groups or 7 groups. The way we went about this was saying, every group has a power, and then every group has, or a set of powers, and then every group has a set of incentives to use those powers. And we define groups differently if they have a sufficiently different set of powers and incentives. And so economic nodes, they have a different set of powers than miners. Investors have a different set of powers and incentives than both of those groups, and so forth. And so then the paper kind of explores the interplay between those 6 groups and how their powers might be different in the case of a soft fork versus a hard fork. And their powers could also be different as a fork progresses. So the kind of the proposing of a fork versus the implementation of the fork versus potentially a rollback of the fork, that kind of whole life cycle of how a fork could go, those different groups have different levels and types of power throughout the process of the change. For investors, they're arguably the most powerful group of all the groups. If there's one that has kind of full control in the long run, it's eventually them. And that's especially true for a hard fork. So, for example, when Bitcoin and Bitcoin Cash split, investors can sell the coin that they don't like and use it to buy more of the coin they like. They can also even participate in futures markets if exchanges set them up ahead of a potential fork, which can determine whether that fork even occurs or set up the probability of how that's going to go. During a soft fork, we found that investors, their power is quite delayed. So when a soft fork is being proposed, when it's being activated by nodes and miners, and that whole process, investors are only able to access indirect power. They can fund developers, they can fund advocacy, but their coins are not yet impactful during a soft fork process or lack thereof. And so that's basically one big power block right there.
Lyn Alden categorizes stakeholders into 6 key groups: economic nodes, investors, miners, influencers, protocol developers, and application developers, each shaping decentralization in distinct ways. Economic nodes, like exchanges, wield significant power due to their influence on transaction volume. Investors, especially during hard forks, can shift market dynamics and hold long-term sway, while miners dictate transaction inclusion and soft fork implementation. Influencers mold public opinion, affecting consensus, and protocol developers, with veto power, control which updates are adopted. Application developers build on Bitcoin's evolving infrastructure. Alden's analysis reveals a multi-layered power structure where no single group dominates, yet each plays a crucial role in Bitcoin's decentralized future. As the network grows, the intricate balance between these forces will determine the path forward, emphasizing the importance of how Bitcoin's ownership and control are distributed.
Miners are obviously a pretty big power block. They have the ability to determine what transactions go into a block as long as they're meeting consensus rules. They have the power to implement soft forks. A fairly small set of mining pools could implement a soft fork, even if the nodes don't agree with it. It would be and we'll probably get into that later. That'll be a fragile soft fork. It's almost like a majority. It's a filtering. It's not a fully adopted soft fork. But they have the power to basically either adopt one or not adopt one. And of course, they have a set of incentives. They want stability in the network. They want to maximize the value of what they're mining, and a whole other set of powers and incentives. Influencers, especially during 2017 when there was a lot of contention around soft forks and hard forks, influencers can play a pretty big role because they can shape opinion of whether a consensus change should be made or should not be made. They can amplify some of the more technical voices that have smaller audiences, or they can counter amplify them. They can basically not amplify them. They can not bring them on their or kind of show them to their audience. And so they can shape the probability or the outcome of how consensus moves forward, and helping determine whether there has been sufficient consensus on the network yet to move forward with a change or not. And then the two developer groups, even though they both write code, so there's protocol developers and application developers, they have different powers and incentives. So protocol developers focus on maintaining Bitcoin itself. They also generally their incentives are going to be more aligned towards stability and security. Kind of like Steve mentioned, almost all changes are keeping it performant as it is, not actually implementing consensus changes. Application developers, they're building things like wallets or other layers or things that can fit on top of Bitcoin in various ways. Their power is different because they're not changing the protocol. They're not merging changes into the protocol, but they are generally more inclined, on average, toward benefiting from more features of the network because that gives them a bigger design surface to build or to improve whatever it is that they're working on. And one of the things we observed in the paper is that the protocol developers, specifically the maintainers, their main power is in vetoing rather than proposing. So I mentioned before that updates can't be pushed to the user; they can only be put out there, and then the user can choose to pull them to their node. They can update their node or not, or on what timeline they want. And one of the frustrations that exists out there when people determine what changes they want to make or not make is that if changes are just not looked at or not implemented by the maintainers, then those changes have a much lower chance of going through. So they have kind of like direct or indirect veto authority to some extent over what changes go in, but there are ways around that, which I assume we'll explore later.
Bitcoin's price has stalled just below $100,000, pausing its impressive post-election rally. The cryptocurrency surged more than 40% since November 5th, the day of the U.S. election, when Donald Trump was re-elected. Despite reaching a new record high, Bitcoin has struggled to break the $100,000 threshold, currently hovering around $93,000. Analysts attribute this pause to profit-taking, with long-term holders distributing substantial amounts of Bitcoin during the rally. Andre Dragosh from Bitwise suggests that the rally is likely taking a short-term break, while Mark Novogratz of Galaxy Digital points out the system's leverage, which has led to a pullback. Novogratz also mentions a large unknown seller pressuring Bitcoin's price by dumping significant amounts. While analysts remain optimistic about Bitcoin's future, David Morrison of Trade Nation cautions that if Bitcoin fades from its current level, it could signal the end of the rally, especially if long-term holders begin cashing out. However, he also notes that Bitcoin could gain momentum for another push higher. Despite the pro-crypto sentiment of Trump's policies, such as plans for a national crypto stockpile, experts like Marion Labour from Deutsche Bank caution that significant regulatory changes remain far off, potentially creating market turbulence. As we come to a close, the question is, how will the distribution of Bitcoin ownership shape its future and the decentralization debate? Will individual coin holders or large entities have the most influence in critical moments like forks? How do the roles of investors, miners, and developers evolve as the network matures? Please share your thoughts in the comments below, share this video, and hit your thumbs on the like button. Thanks for watching, and don't forget to subscribe.